Welcome to the 2024 Economic Depression and Preparation Channel. I'm your host, Tony. Thank you for joining me on this weekend edition. Briefly, June 2nd, 2024. We're halfway through the year, heading into the third quarter here. And so far, inflation has rose less than expected, but is continuing to be a headline among most American shoppers and most American buyers of products and services, goods and services every day. So the good news is it didn't rose as fast last month, but it is still hanging around and creating problems for Americans all across this country. And we're going to look at this continuing to be an issue as long as the first quarter results, economic results, will revise downward. We also have a wage and job growth problem issue as well. Even though new jobs are being created, 200,000 average per month, it still presents problems in terms of wages trying to keep up with this inflationary measures on gas, food, utilities, transportation, manufacturing, and as well as other things, pressures, international pressures that are coming into play on the U.S. dollar. Please be sure to subscribe to this channel for the latest interpretation of financial news. I'm not a financial advisor, but I do interpret financial news and give you the 100% unadulterated truth in terms of what's going on with this economy. So thank you for your support, ladies and gentlemen. Let's get right into it. We're looking at it right now. You can see the Fed's measure, according to CNBC.com, it only rose 0.2% in April as expected. So they expected this. The markets expected this. Markets were down, as you know, on Friday. And as the markets closed and as we got through the Memorial Day weekend. Now we're into June here. We're getting into summertime. The kids are out of school. Many people are thinking about trips, vacation, some vacation, whether locally or abroad. And that's going to also, people are going to be watching that closely in terms of the plane ticket sales, or train or cruise sales, etc. That's also, we got to look at that in terms of the inflationary data. But in any event, the core inflation data came back at 2.8%. That's fine, because most people are thinking, most economists are thinking, they're still expecting that rate cut to come in. Let me know your comments on that. What do you think? Do you think there's going to be one rate cut this year by December, or do you think there's going to be no rate cuts and they're just going to leave rates unchanged throughout the remainder of this year? I am more of the camp that they're going to leave rates unchanged this year. They're not going to be a cut. Some people, most of the expert economists said it's going to be one cut. I don't even think there's going to be one cut because of the prevailing conditions of this economy that we're going on. So American shoppers are tired. Quote, this is CNN Business. These companies are benefiting. Companies raise their prices and they say it's because of the inflation. The input costs are raising. They raise the wages of these retail workers and fast food workers in these retail stores. They raise the minimum wage. But the problem is that a lot of these companies are greedy. They raise their prices way high. And this is evidenced by Walgreens. You guys remember seeing that this past weekend. Walgreens decided to lower their prices by 20 or 30%, 50%, because they were overcharging people. And we knew that from a fact. Most people that went to these stores, they were been overcharging. And not just them, but a lot of companies were overcharging, not just during the pandemic and all of that, but after the pandemic, they kept prices high to fleece people on these things that you can get cheaper at cheaper online stores like on Amazon or Shine or Temu or whatever you use. So American shoppers are, quote, tired. This is an article by Brian Mina. He says that Americans are worn down by high inflation and interest rates. Companies that offer bargains and staples are reaping the rewards, right? So Ross, all these stores, they're opening 90 new stores this year, and they're the same. These stores like Ross, TJ Maxx, Marshalls, these type of stores in the retail industry, they're all offering the same, but they're opening up new stores. Here we go. TJ Maxx, Marshalls, and home goods stores are also benefiting. They reported strong revenue in the latest quarter and also plan to expand its physical footprint. Now, that's interesting. As we're going more digital and online, these stores are expanding their physical footprint. More than 1,300 stores in North America, Europe, and Australia. Dollar General, as the article says, they continue to add stores. So my question is, they're saying they're hurting, companies are hurting, but they're not really. They're adding more stores, and apparently the new wages and minimum wages with some of these companies are not hurting these businesses. They're still making record profits, and that's even the case with chip manufacturers and other companies as well. So this is what we see. Fast food deals were off the table. Now they're roaring back. McDonald's was the only one that's been suffering, and now they're bringing it back the $5 menu, as you can see. All of these different things are playing into case. So regardless of a downturn or economic boom, companies will make money. They're in business to make a profit, and that's what they will do to satisfy the shareholders and the stakeholders in the business, ladies and gentlemen. So that always will be the case. the middle class, the people that the 99%, the rest of us, the poor, we suffer the consequences because we have to pay whatever they demand because they have the access to the goods and services that we need, like food, water, security, transportation, utilities, etc. Right? So that's the question. Now, first quarter economic growth revised downward on a weaker consumer spending. Well, this is U.S. News and Report. Now, remember, these reports come out 6 months or 7 months after the fact. We know that we've been seeing a slowdown since last year, beginning of last year, but now it's just now it's just starting to come into the wash, especially with these autos. We have these truck plants, these auto plants. You can imagine these cars sitting here with these loan terms, interest rates for autos, 12%, 13%, 14%. You're talking about, people making $1,000 payments on these more on these with insurance on these new vehicles, newer style trucks and stuff. And even these electric EV cars are costing a heck of a lot of money. I couldn't believe it when you go in and you try to get a new truck, let's say a new F-150. You're talking 50, 60K easily. That's just the base models. Now, if you want a King Ranch extended cab and all that, a Raptor or something like that, you're talking 90 to 100K for a pickup truck. Where it used to be 10 years ago or 12 years ago, trucks weren't running this high. But now, for the basic model trucks, you're talking 50, 60, 70, 80K for a truck. And people are paying that. And it's just crazy. But this is what we're dealing with because this is the demand is apparently there, and they're going to keep bringing these trucks here. But now we have a lot of trucks sitting on the lot. We have cars sitting on the lot at CarMax and all these places that people are showing you on YouTube, and that's going to continue. And the only people that are buying it is like rental fleets and stuff like that are buying auctions and rental fleets. Those are going to continue to go, but the used car market will continue to be strong, and people are getting repairs on cars. As you know, they're getting repairs on cars to keep their car lasting longer, as the average age for the U.S. car is now 12 years or older, because it's so expensive to get a new or used car in the finance if it's 5 or 6, 7 years, 8 years even. It's just so much expensive. And they're probably experiencing this to a lesser degree in Europe, in the EU market, as well as an Asian market. But even though their cars are smaller than ours, because people are just not having the kind of disposable income to do this on these cars with the insurance, taxes, gas, vehicle taxes, all this kind of stuff they got going on, tolls, everything. It's just terrible. So let me know what you think, how this is going to play out in summertime. Are you planning on taking a summer vacation with your family during this time from May to July, August, as the kids are out of school? Do you plan on continuing to save? Where would you place your money as a hedge against inflation? Is it gold, silver, crypto? Is it land, oil, real estate, some kind of Airbnbs? Let me know where you're placing your money to hedge against this inflation that's persistent and will continue to be persistent and consistent throughout this year and next year, regardless of the presidency or regardless of the economic policy. We're just in that point now where we have too many dollars chasing too few goods. So let me know what you think about in the comments. Thank you for joining me today. Enjoy your weekend, and I'll talk to you very soon on the next episode.